following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there didn't miss us too much over this nice, fun weekend here. Don and I took a bit of a hiatus, and we were recording a wee bit late, but better late than never, as they say. My name is Mark Longo from the OptionsInsider.com, as well as many of the shows here on the Options Insider Radio Network. And I am coming to you today hopped up on pain pills due to a heat-related mishap in the old kitchen this weekend. So I'm a wee bit loopy today, so you might be hearing Don for most of the show, but I will contribute where I may today. Speaking
of... the question is, will I sound loopier normal than you do on pain pills?
That'll be a good one for the listeners. There's the home game they can play. Compare the relative loopiness. That voice, of course, is my boon companion, the yin to my yang, none other than Don Schlesinger, the major domo down there at the Volatility Exchange. Don, welcome back to the show.
Always a pleasure, and we'll probably talk about it a little later. We're just a week away from coming out to Chicago to exhibit at the annual FIA show, and looking forward to hopefully greeting and meeting some of our listeners there.
Yeah, FIA is a great show. If you're in Chicago, you should definitely swing down to make it. If you're around the Chicago area, it's definitely worth swinging in. It's one of the few industry shows that I would say has some interest even to the active retail component. Just for the vendor hall alone, it's an enormous vendor hall. They have rows of international exchanges exhibiting there, rows of vendors, rows of you name it, it's all down there. So if you're a vendor hall tchotchke kind of fellow, this is the show for you. And Don and I are working on getting you guys some free access to the exhibit hall. I know if you go to the website now for the show, it says it's $50 to get in for the exhibit hall and $1,000 for the full conference. We're working on seeing what we can do to get you guys in there without having to pay to listen to our fine shows next week. Stay tuned, listeners. We'll see if we have some updates for you throughout the show on the progress of that. But with that, we are going to roll right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we discuss volatility in all of its many forms and facets. Last week, we dove into the ever-interesting world of metals volatility, as well as a number of other fun products with our good friend, our volatility pit reporter, Mark Sebastian from OptionPit.com. And now I will toss it to Mark once again. Mr. Sebastian, what did you see in your volatility review for the past, let's say week and a day?
You know, it's interesting. Things were just absolutely blowing up. And then in the last 2 days, it's almost like the volatility has just come out of VIX options and of VIX. VIX has stopped rallying with the market. As we're recording this, the S&Ps are down 25 points and the VIX is barely up a point. It shows you how high vol is, where if we can be down 2%, and that's not enough to cover VIX, because VIX is really pricing almost 3%. So we're at a crossroads.
I don't know
here.
if the broad market realizes that fact, that they're pricing in a substantial move on a day-to-day basis at these current VIX levels we're looking at right now.
It's interesting. we're at a crossroads where we're either vol's going to have to start coming in, or we're going to have to really tank. And it's one of those two.
Well, Greece is trying. Greece is doing its best.
It's doing its best, but I almost think default would lower the VIX. That's would lower vols.
That's the way I feel. By the rumor, sell the fact.
Exactly. And
by the way, what is that delicious sandwich you're munching on as you're talking to us?
Egg salad.
Egg salad.
Yeah, I'm just not buying anything I'm seeing. It's really weird. We're sitting right at, quote unquote technical levels. So these next couple days are going to be very, very, very interesting.
Yeah, we're dancing around the 1100 level right now in the S&P as we're recording this, which is late on Monday afternoon here in Chicago. So yeah, we're pushing that 1100 level. We'll see if we break through it towards the end of the day. And of course, did you watch any gold and metals action over the past week?
Yeah, they brought in gold vol. Gold has stopped moving. So, it's interesting. Yeah, gold has been in a really tight range, and I think it's going to be in a tight range for a little while. I think it's going to be GLD is going to sit around, 160, 165 for the next couple of weeks. That premium is getting sold off pretty substantially here, although it's kind of balanced out at still really far levels. I think GVZ's got another 4 points to sell off. That's kind of what I'm saying. What about you?
If you can get any volume off in that GVZ contract, it's
which you can't.
Notoriously thin issue at the moment. But if you can get a 5 lot or a 10 lot off, then I guess you're doing well out there.
If you can get a 1 lot off, you're doing well out there.
All right, and thank you for that, Mark. And of course, here on this program, we discuss all things vol related, and that includes the world of Euro vol and Euro VolContracts. And Don, I believe you made a very salient prognostication on the last show. So why don't you give our listeners a bit of an update on how that pick worked out?
Well, I guess you'll recall it's a little bit more than a week now because we recorded a week ago Friday, so we were looking at Thursday settlement prices, and now I'm looking at this past Friday's settlement prices, so just a little bit more than a week. But listeners might remember that at the recording of the last show, we had extremely elevated levels, at least insofar as Eurovol is concerned. And we actually had a settlement price on Thursday, the 22nd, of 17.16 for the 3-month December volatility contract and 15.87 for the 1 month, the front month, October. And that kind of caught my eye because from the historical perspective and from forecast volatilities from Robert Engel at the Volatility Institute at NYU, those numbers looked awfully high to me. Now, obviously, listeners might understand that there's justification for that, tremendous amount of unsettlement and unrest in Europe and particularly in Greece that could have an impact on the euro and currencies and what have you. Nonetheless, I did suggest that possibly that was a sale at those levels and that it would be more likely over the next week that those numbers would come in rather than vice versa. Well, Friday settlement had the 3 vol at 13.10, so a drop of over 4 points in the 1 week. And the October 1 vol down from 15.87 to 13.25. And so a single 1 lot, of course, again, the usual caveat that you can't always transact at the settlement prices. Those settlement prices, especially in all futures markets, are not always what we would refer to as a last sale for a stock market, but rather a theoretical value that are put up by the exchanges at the end of the day. Doesn't always represent a transaction that took place there. Nonetheless, you had a little over 4 points in the 3 vol, and you had about $2.62 in the 1 vol. So cumulatively, if you had sold a single one of each of those contracts and you could just mark them to the market at the settlement prices, there was $6.64 in the 2 of them combined, which is pretty outrageous for 1 week. 1,000 multiplier on these Euro vol contracts, so $6,640 just settlement to settlement. A 10 lot short of each one wouldn't have been too bad for a week's worth, huh, Mark? About 66 grand or so.
I'm telling you, Don, we're giving our listeners gold here, and I hope some of them are at least diving in and taking a part of some of these. And of course, your caveats applying. It's difficult to get substantial size off at those prices, but they can get some off. At least a one lot, I would think, off at those prices.
They can certainly get a one lot, and I think they wouldn't have too much problem with a 10 lot either. We saw some 20 up markets last week. They, of course, fluctuate as the investors or the market makers are in and out and adjusting their markets, but there surely is enough liquidity to trade the smaller lot sizes.
Well, you heard that. You heard it from Don here, listeners. It's time to start diving in on these spreads, because as we've seen time and again and week after week here on the show, the movements in these vol contracts are just extraordinary. And if you're looking for a product that exhibits some volatility and some movements and some trading opportunities, then you could definitely do worse than looking at some vol contracts right now.
Actually, Mark, just a very quick update. I'm trying to get markets, and they change, as listeners know, every second as you speak. But there's a posted 1377 at 1402 market on the October front month one vol. The bid is small, but there's actually 20 offered at 1402. So again, as I said, there's certainly room to trade in reasonable sizes in these markets.
Yeah, on 1,000 multiplier, 20 lots is a substantial size trade. This isn't the typical 100x multiplier that a lot of our listeners are familiar with for trading equity options. This is a 10 times larger, so that's a substantial size offer. And that should definitely address some of the concerns we've heard over the past few months, people coming in saying they're trying to trade vol contracts and they were having difficulty finding size on the bids and offers. Well, it looks like that size has definitely increased, at least to the point where you could dive in and do 5 lots or 10 lots or more on some of these trades that we've been outlining here. Don, I'm telling you, we bought someone an island in the Bahamas over the past few months. I know it.
Also, a quick update for the 3 vol. There is a 20 up market there as well, high 12s into the mid 13s. And so once again, same comment applies. Looking to trade out a little bit farther, period that would encompass anything that might happen in Greece and go through the October, and the period might look at the 3 vol or the December 3-month realized volatility.
It's impressive that the liquidity providers are willing to step up to that relatively decent amount of size in the euro product, given everything that's going on in that part of the world right now. You think they might actually be scaling back a little bit and widening out.
Yeah, we've got a few brave souls there. They're good. They're our loyal market makers have been there, Optiver and Infinium, since the very beginning.
All right, listeners, you have your homework. Go find your spread and execute it and capture some of these theoretical profits we've been outlining for weeks now here in the old Euro vol contract. And that's going to do it for our volatility review portion of the show. And now we're going to dive right into our volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is the portion of the show where Don and I kibitz around a cup of coffee about some of the interesting topics in the world of volatility. Occasionally we bring on some guests. As listeners know, we've had some pretty heavy hitters in this segment of the show in the past, so it's a pretty fun segment to do. This week, Don and I, mostly Don, as I alluded to earlier, is not exactly firing on all cylinders today, so mostly Don are going to kibitz about the topics of the day in terms of volatility. And today's actual topic in our Volatility Viewpoint segment is more of a refresher, I suppose you can call it. We discuss a lot of various topics on this show about skew and other factors that I think assume a certain level of knowledge or understanding of the basic components of what go into statistics And factors like skew, things like mean and median, and all those other fun factors, kurtosis, and all those other fun things that you may have bumped into in your college statistics class and then promptly forgotten about shortly thereafter. But they are indeed important aspects of what we talk about on this show on a regular basis. So we thought it might be a good idea to dive into a few of those topics and discuss their importance in terms of how they apply to volatility calculations. So Don, like I said, I'm not exactly on my A game today, so I will let you take this ball and run with it, sir.
Well, thank you, Mark. And again, as you said, these are certain concepts that we have touched upon and discussed in one form or another over the, I guess it's probably a good 6-7 months that we've been doing the show now. How time flies. I think we're up to number 24 or 25, and we had a couple of introductory shows. So I sometimes marvel at the fact that we've actually done so many.
Yeah, we're cranking away here.
We sometimes come full cycle, and we actually wind up discussing certain concepts, at least in part, more than once. But I'm going to try to give a quick review, a little bit of a primer on distributions and some of the moments of the distribution, mean, standard deviation, skewness, and kurtosis. We'll try to keep it very light and give intuitive examples, never going to be too heavy on the math, but I think it's rather important. And so we start off with the simplest of notions. If you take a coin and you flip it 100 times and that coin is a fair or balanced one, we kind of all know that the average or mean or expected number of heads would be 50, since there's a 50-50 chance of getting heads or tails, but that there's a distribution around that mean. And that distribution goes above 50, you can get 60 heads, you can get 55, 62, and it goes below to the negative side. And the result on a histogram of kind of plotting all of these, if you do it over and over, millions of times, the curve finally smooths out, and it describes the classic bell curve, or what we refer to as the normal distribution. Normal distribution has certain characteristics to it. One of them is that the mean is also the most likely outcome, and the mean also divides the outcomes 50-50 above and below symmetrically. So that's one of the properties of the normal distribution. And then we calculate standard deviations or movement around that mean, and we make certain probabilistic statements, such as if I go -1 standard deviation to positive, there's a certain area between those 2 points, and it's a little more than 68%. If I go 2 standard deviations, it's a little more than 95%. And if I go 3 standard deviations, we get almost all the area under the curve, or about 99.7%. So what we call the outliers, or the tails of the distribution, once we go out 3 standard deviations, there's not a lot left. So with a coin toss, listeners might know that 1 standard deviation is 5 up or down. So by the time you'd go out 3 standard deviations, 3 times 5, you'd add 15 to the mean of 50, you'd be up at 65, or you'd subtract 15 from 50, and you'd be down at 35. And so the statement that we would make is you'd be really hard pressed to flip a coin 100 times if it's a fair coin and get a result that would be fewer than 35 heads or more than 65 heads. The probability is all packed in between plus or minus 3 standard deviations, and any of those outliers are indeed very, very rare, expressed in thousandths of a percent, and therefore very unlikely. Okay, fine. Well, now we come over to the stock market, and we take a look at stock returns, or we take a look at stock prices, and we start to plot their mean and their median, where you have 50% above or below. And we find that the curve isn't symmetrical, and it doesn't look like the standard normal distribution, and it's different in several different ways. And so the first thing that we notice is that the mean and the median are not the same. Explaining that in layman's terms, the average result, the result that we get from adding up all of the different returns or movements and dividing by the number of those movements, that's the mean, or what people usually refer to as a standard average, okay? We find out that that average is, in fact, it's not the 50-50 dividing point. It's not where 50% of the results are above and 50% of the results are below. The median doesn't coincide with the mean. And before I tell you which side the median is on with respect to the mean, I want to throw out a little challenge to our listeners, and it's kind of fun. I do this when I lecture on options on an annual basis, mostly at Morgan Stanley for the new MBAs who are coming in and the new hires. This always elicits a rather interesting response. So the question is, suppose you have a stock that's currently at 100 today. And to make it very simple, there are no dividends and the risk-free rate is 0. So there's no drift at all to the price of that stock. And therefore the forward is also 100. Okay? And let's, for my first example, suppose that the stock has a 20% volatility, annualized standard deviation. We're going to talk more about that calculation in a minute, but 20% volatility. And the question is, 1 year from today, what is the mean of that stock in terms of its returns? Well, it's not going to have any drift, so the answer is 100. Okay, so basically the mean return will be 0, and we would have the actual 100 point as being the mean of the distribution. Only now I ask another question, and that question is, what is the median? What's the 50-50 point? So the question is, where would I expect the 50-50 break point to be 1 year from today? Should I expect it to be at the same 100, probability 50% that the stock will be above 100, 50% below 100? After all, there's no drift, there's no interest rate, there's no dividends. Should I expect it to be above 100? I mean, stock's got a volatility, and we know it can, go much higher, it can go lower. Or should I expect it to be below 100? And when you ask this to a group of people, you get about roughly half the group that would say, well, I see no reason for the 50-50 point to be anywhere but 100. And then you get another half of the group that says, no, I think it's higher than 100. I think that, you said there's no drift, but stock has a volatility, and I know it could go up forever. It can only go down so much. You get the group divided 50-50. And then we kind of raise some eyebrows, because the correct answer is lower than 100. The median of the distribution for stock prices is to the left of the mean. And with a stock of a 20% volatility, the median, the 50-50 point, is at about 98 or so. I'm going to make another point in a moment that's even kind of more surprising. So then you say, well, I'm trying to understand why this should be so. And the answer is that stock prices are log normally distributed. It's not their prices that are normally distributed, but the logarithms of those prices. And when you think about it, if we don't take a $100 stock, but we take perhaps a $10 stock, $10 stock might go up to 100, might go up to 200. So we know it's got that long streaming tail to the right on the upside, allowing for any conceivable movement. but it can only go down 10 points to zero, can't go below zero. So there's a tremendous amount of probability of prices that are packed into that area from 10 down to zero, while a lot of the rest of the prices are kind of stretched out and spread out way above 10, and not with a lot of probability, but with some points, 40, 50, 60, 70, etc. So we get this asymmetric shape, the shape of the curve that's not a smooth, balanced, symmetrical bell curve, but rather this asymmetric log normal distribution where the median, the 50-50 breakpoint, is to the left of the mean. And so if we take that one step further, we get another very interesting concept, and that is what's controlling where that median is actually the volatility of the stock. It's the standard deviation of the returns of the stock. And you get what for some people is a counterintuitive conclusion that is nonetheless mathematically true and correct. And that is the higher the volatility, the farther to the left the median is with respect to the mean. It's something that's not always intuitive to people. So now if I take that same $100 stock and I say I'm going to increase the volatility from 20% to 50%, now where's my 50-50 break even? Some people think quite extraordinarily the answer for the median is that it's now at 88 rather than 98. That means a year from today, half the time, the stock price would be above 88, nowhere near 100. And believe it or not, half the time, the stock price would be below 88. Again, there's no drift here or no risk premium involved for the stock. So that might be counterintuitive to a lot of people, but again, what you're looking at is a distribution where that hump is to the left of the mean and where there's more outcomes kind of packed in to the downside than there is to the upside. So that makes kind of hitting a target to the downside actually more likely than hitting the same target that's equidistant to the upside. And again, this is not something that's intuitive in people's experiences. Now, of course, I've actually kind of made this risk neutral discussion where there's no premium for owning stocks and where there's no drift and where the interest rates are not higher than the dividend yields, which is pretty much the case these days anyway. But the conclusion is nonetheless that we have this asymmetry. So that's one of the points that I wanted to make today, but there's still another one. And the other one has to do with the actual third and fourth moments of a stock price distribution. The first moment is referred to as the mean, the second, the standard deviation, which is volatility for stocks. Those third and fourth moments of a distribution are skewness and kurtosis. Okay? So skewness refers to this concept that I was just speaking about, where we take a look at where we have more results to one side or the other of the mean. And what we find for stocks is that stocks are negatively skewed with respect to their returns. What that means very simply is that unlike our coin flip demonstration where there were just as many results to the left of the mean as there were to the right of the mean, that isn't the case with a stock distribution. And so what we find in defining negative skewness is that we get more results, as I've just been discussing, to the left of the mean than we do to the right. Now, before people jump to the conclusion, oh, well, then, there's some sort of negative return, don't forget that just because you have more points, more data points to the left of the mean than to the right, doesn't change the fact that in my examples, the mean was still 100. And that's because you have this weighted average where as you add up all the different returns and divide by the number that you have, you can get some results that are 100 points, 200 points, 300 points above that mean of 100, but you can never get a result that's more than 100 points below because you bump into zero again. So again, we have this asymmetry where if you add up all the returns and divide by the number, you'd get 100 in my example. That's the mean. But if you count the number of returns and place them to the left or to the right of the mean, you're going to have more of them packed in to the left. And so we refer to that as negative skewness. So that's a property of stock returns. Finally, that fourth moment is what we refer to as kurtosis, and we find that stock returns are, we mentioned this Greek term before, leptokurtic. Leptokurtosis refers to the fact that the distribution sort of has that skinny hump in the middle, and you've got to make up for the lack of probability there, and you do so by kind of packing a little extra into the tails of the distribution. That would be the extremes all the way to the left and all the way to the right. So for a normal distribution, we talked about 3 standard deviations up or down, comprising almost all of the area under the curve. When you look at plus or minus 3 standard deviations in our coin toss, there's almost nothing left in those tails, very skinny off to the left and off to the right. So that plus 3 kind of defines the 3 sigma, or the kurtosis of plus 3 or positive 3 for the standard normal distribution. Well, stocks and individual stocks or stock indices have kurtosis considerably larger than 3. What that means is that it would take many more than those number of standard deviations to get that 99.7% of the distribution. And if we just take a look at the standard 3, we find that there's a lot more data points in the tails than we might have expected from, quote, normal or the normal distribution. So the tails are fat. And what that means is that we get more results as outliers, extreme up moves, extreme down moves, than you would expect if the prices were normally distributed. Now, notice that the skewness tells us that not only will we have these fat tails, this leptokurtic distribution, but that we'll also have more of these outliers, therefore, to the left side of the mean than we will to the right, and therefore the tails are not only fat, but they're not fat in equal amounts, if you will. So all of this meant to be a quick review for our listeners of the differences between a normal symmetrical distribution and how stock prices behave, and how we actually take a look at these different moments of a distribution.
Thank you for that, Don. That was a exhaustive overview of the various elements that go into a lot of these statistical calculations that you and I just bandy about on this show willy-nilly, with reckless disregard for whether or not our listeners can follow what the heck we're talking about. So I'm glad you were able to take it on the chin this week and do that one for me, Don, because quite frankly, given all this medication I'm not sure what would have come out of my mouth if I had decided to delve into that lengthy of a discussion on kurtosis and skewness and logarithmic returns.
Well, glad to oblige, Mark. And by the way, I'm going to jump in with an update here. We promised listeners that we'd try to get something up on our website or get information about those potential complimentary exhibit passes. And it's breaking news as we speak. If you go to volx.us, that's our website, volx.us, and you go to the home page, you'll now find the FIA logo at the very top under Volx announcements, and the text invites you to register now for a complimentary exhibits only pass. And listeners can find this at the very top of the page, and it says the Volatility Exchange invites you to the Chicago FIA Futures and Options Expo trade show floor on October 10th through the 12th, 2011. Click on the Register Now hypertext to register for a complimentary exhibit-only pass. And when you click on that, you'll see the logo and you'll see Hilton Chicago. The show is being held at the Hilton this year, and a big Register Now button. So we invite listeners of the Options Insider and of our Volatility View shows to please avail themselves of that. We'd love to see you next week. Stop by our exhibit booth as you're browsing around, and please do attend the taping that we're going to have of Volatility Views live from 5 to 6 Central Time on Tuesday, October the 11th. We'd love to see you. We'd love to chat with you, and we're happy to offer these passes.
Well, that's great news. I'm glad we could offer that through you guys. We were looking around at a variety of different partners to find passes for this, and that's a perk that they limit exclusively to exhibitors. And I assume since you guys were exhibiting as well, that it would make sense to have you guys offer them. And I'm glad you're able to get. That's pretty quick turnaround time. I'm impressed. Since we started the show, you were already able to get the link up on the website and get the badge up there and the URL. I'm impressed. That's Norm cranking away again behind the scenes tirelessly.
That's our spectacular webmaster, and thanks to Glenn at the Volatility Exchange, who was busy on the phones knowing that we had a deadline for airtime on the show, and to Bob Kraus, obviously our CEO, for putting this all together. So we're happy to offer that, and it's actually Monday now at a little bit before 1 o'clock Eastern time, but listeners will hear the show tomorrow, Tuesday, and again, everything is up and waiting for you to avail yourselves of these complimentary passes.
Yeah, so definitely take advantage of that. We'd love to see you down when we're recording our episodes there on the FIA Expo floor. And also, it's great for you guys, the listeners, to get a chance to get into this show. Usually it is reserved for industry folks to get a chance to come around, check out the booths, check out the show exhibits, and also come see Don live. He makes quite the fetching booth babe, if I do say so myself.
Now you're just setting them up for disappointment.
The miniskirt may be a bit much, Don, but everything else I find works very well for you. All right, and with that awfully disturbing image in mind, we're going to close out the Volatility Viewpoint segment for today and roll right into our mailbag.
Listener mail. Listeners write in.
Mailed in.
Mailbox.
All right, and welcome to the mailbag. This is, of course, the portion of the show where we drag out the dusty old mailbag and peer deep into its recesses to see what gold we have lurking therein. And today, it's a question from our forum on the optionsinsider.com. And again, if you'd like to be featured in this segment and you have some salient questions for us here on the show, or maybe even some comments, by all means, surf on over to the optionsinsider.com and click on the forum tab, and you will find the Volatility Views listener questions topic thread right there. Just post your question right in there, and we will, if it's interesting and or intriguing, we will read it here on the show, just like our good friend Captain Options here today. I love that handle. That's a good one. And he posted, given the explosion of popularity in weekly options, I'm curious if Mark and Don think there is room for short-term realized volatility products. Would a weekly realized vol product even make sense at this point given the short time frame of the product? Can you generate a worthwhile calculation of volatility in such a short time frame? And of course, So I'll dive into this first, Don, and I'll let you run with it. Because my answer, given all that's going on today, will be, I'm sure, brief. But I think there actually would be a fantastic product category. And given the explosion of interest we've seen in weekly options, I think there'd be a tremendous amount of ARB and back and forth trading between those two different product classes. People could trade the weekly equity options and then hedge them and or ARB them with the weekly volatility products. It would be a huge win, I think, for everyone involved. In terms of his question about generating a worthwhile calculation of volatility in such a short time frame, well, we do it right now for much shorter time frames. People do daily volatility and all sorts of smaller frame of reference volatility calculations. So long as you bear in mind that it is indeed a weekly vol number and it's subject to be a little bit more, let's say, volatile than a year-to-year volatility measurement, then I think it's fine. And like we discussed on the show a few episodes ago with you and Sinclair, it really is all about your frame of reference when you're looking at volatility. And I think a week is certainly a viable frame of reference to measure and analyze and trade volatility. What say you, Don?
Well, I agree with everything that you've said, and we will certainly look into it. One of the questions would be whether there would just be a close-to-close single-day reading, or whether we would have to drop in more than once during the period. And I answered online, as I try to do as soon as these questions come up.
And I think a close-to-close weekly contract would somehow be anticlimactic, I think you want a few more data points in there.
So that's the point. You know, our realized volatility calculation, as we define by the vol formula at the volatility exchange, is a close-to-close intraday standard deviation of returns. And if our listeners know a little bit about statistics, they'll understand that to really get a meaningful standard deviation for some sample population, it's always kind of been recommended that you need a minimum of maybe 20 sample points. And so if we were to stick with the weeklies on a close-to-close measurement, you'd have only 5 such data points. And I think we'd fall, pretty well short of that requisite number to have something more meaningful. So one way to remedy that would simply to be more readings every day, intraday, possibly at the first opening print, then 2 or 3 hours later, and 2 or 3 hours after that, and then on the close. If you did it, 4 times a day for 5 days, 5 trading days, you'd have 20 such points, and that would give you a reading. But of course, we would then be kind of in some way violating the spirit of the close-to-close formula that's enunciated for the vol formula that we use. So there are methods, and we won't get into them at the moment, for adjusting such readings so that what you would come up with would be an actual surrogate for a close-to-close volatility, but you would do so in a more compact period of time. So would let you have an approximation of the close-to-close volatility. And you mentioned Ewan Sinclair, and he talked about how you might be able to do that by getting bands around the current reading and how quickly you would reach an upper band or a lower band. So there are certain conventions to be worked out, but that should not be an impediment towards deciding whether or not you would want to have such a vehicle or such an instrument. And we'll certainly work out the details if there's a demand for the product. And I think that there's, as you said, such a demand already for the weekly options that it would be hard to think that the demand would not be commensurate and grow apace for a volatility instrument that would settle for the same time frame as the options are. So certainly something that we will look into, especially as we look to develop vol contracts on equity products.
Yes, there's so much inertia right now in the options market for shorter duration products. Everything's moving towards the weeklies. There's discussion of dailies and all sorts of other interesting short-term contracts. So given so much interest, so much inertia going towards the shorter duration contracts, I'd imagine that it's only a matter of time before we have something along the similar lines in the volatility spectrum as well. So thank you for writing in there, Captain Options. And again, I love the handle. I may have to borrow that on occasion. Maybe I'll go for Halloween. This year I'll be Captain Options. What do you say? I don't know what that outfit would look like, but it leaves a lot of room for the imagination. All right, and maybe with an equally disturbing image in your mind as the last segment, we're going to close out the old mailbag and roll right into the crystal ball segment.
And now we take a look at the crystal ball.
Regardless of how active you are as a trader or an investor, a firm understanding of the inner workings of market volatility is crucial. You are invited to join pro options trader Mark Sebastian and pro futures trader Jeff Quinto for this one-of-a-kind live event on October 21st at the Chicago Mercantile Exchange headquarters. After Jeff discusses how volatility can play into the hand of a futures trader and Mark covers how to use volatility to trade options on futures, together they'll present unique combination strategies using futures and options in tandem. This interactive event will benefit every level of investor, from the novice futures investor to the most active futures and options day trader. Don't miss this rare chance to see two industry experts in one spot. Please go to pricegroup.com to reserve your tickets today. The cost of this all-day event is $895 before October 1st, with $500 off for Price Group customers and new accounts. Again, please go to pricegroup.com to reserve your tickets today.
And welcome to the Crystal Ball. This is, of course, the portion of the show where we prognosticate wildly. We gaze deep into our crystal balls and look at the future of volatility. And we're going to kick things off with our good old volatility pit reporter, Mr. Mark Sebastian from optionpit.com. Mr. Egg Salad, what are you seeing in your tasty, delicious crystal ball for the week ahead?
Their pricing, it looks like we're going lower, and it looks like vol's going to stay stabilizing. So kind of interesting, but I'm expecting stable option vols. I'm expecting realized vols staying around 2.5% a day. I think we got a trip down another 5 to 6% from here. We'll see where that holds up. S&P futures broke kind of a key level just now. We'll see whether it can drag the SPX below 1100, at which case we're going to see a major amount of stop orders firing. For the week ahead, I'm going to be watching that employment report. I'm going to be watching, because if people look back and go, oh, wait, the economy was not doing that bad at the time, then maybe that'll change some opinions. We'll see. I think in the next week or two, we're going to see something major come out of Europe, and it's going to kind of change the whole, basically everything up and down that's going on in the marketplace. So those are the kind of the things I'm watching.
So once again, have those units in your back pocket for a rainy day that could be coming in the next few weeks, if not sooner. All right, thank you for that, Mark. And Don, your crystal ball has been on fire of late, just lighting up the tape with all sorts of fantastic spreads and potential ARB opportunities. So I'm sure our listeners are salivating at what potential money-making scheme you can conjure forth for them this week, sir. So Don, what do you have in your crystal ball, sir?
Too much pressure. See,
I gave you quite the build-up there.
I need to take a pass. I can hear the booze already, but... This is, of course, a really tough one now. The prices have come in to, I'm looking at the Euro vol, to somewhat more reasonable historic levels. And when that happens, and you're not at one extreme or another, you're not down at 7s and 8s and 9s that we saw earlier in the year, nor are you at 16s and 17s, but you're smack in the middle of the range that historically has been the volatility of the euro in the 13 range or so. It makes forecasting a whole lot more difficult. We now have 15 days out of 20 already logged in the 1 month contract, the October front month. So there's only 5 days left in that particular contract, and the partial volatility is a little above 12 at 12.23, and yet we are trading up in the 13s and 14s, which would imply that volatility for this next week would have to be as high as almost 16 in order to justify even a price in the low 13s, because don't forget, 3/4 of the value of the contract in number of days has actually been logged, then it's 12.23. So very, very cautiously, if I'm using a 13.25 settlement price, very cautiously, I'd say we might come in a little bit from there, but I don't have a strong conviction. Insofar as the 3-month, really that's kind of anybody's guess. With the whole Greek situation looming in the distance for the month of October, and with 49 days to go to the expiration of the December 3 vol, I would say that the current 13 to 14 level is certainly justifiable and certainly reasonable. So I don't have a strong conviction there at the moment.
Don, how are our listeners going to buy their islands in the Bahamas if indeed you have no strong convictions this week, sir?
Not from that one. Sorry about that.
No potential to arb 5 or 6 points this week then. But stay tuned, listeners. I'm sure those opportunities are lurking in the wings yet again on a future episode of Volatility Views.
There you go. You have to amortize it over the long run.
You can't hit a home run every week on in the tip section, but there were some strong bunts, and every once in a while we knock it out of the park. All right. And speaking of future episodes of Volatility Views, that is going to do it for this episode of the old show. I want to thank Mark Sebastian and Don Schlesinger for joining me on the program today. And Don, I think we discussed it before, but we always talk this part of the show about what's new and exciting up on the Volex website, volex.us for our listeners who don't know the URL. But I think we already mentioned it already, that it is indeed the link to the FIA Expo free passes for our listeners. And that's a pretty great benefit because, like we said, it's an expensive show to attend. It's $1,000 for the full show. It's $50 if you just want to go see the exhibit hall. So they get you every which way but loose at this show. So I'm glad we can make it available to our listeners to come in for free and listen to the shows we're recording. Again, we'll be recording from 4 to 6 on Tuesday the 11th, and then 1:30 to 2:30 on Wednesday the 12th. At 4 p.m. on Tuesday, we'll be doing the option block. At 5 p.m., we'll be followed hard on the heels by Volatility Views, this program. And then on Wednesday, we'll be doing the long and short of futures options with our friends over at the CME. So a lot of fun shows coming up live at the FIA Expo. And I encourage you, if you are in or around the Chicago area next week, by all means, swing on down to the Hilton. It's a fun show. It's definitely, I do a lot of these shows throughout the year, listeners, trust me, and this is definitely the best exhibit hall to go see. If you're going to do one show from an exhibit hall basis, it's definitely worth it. You'll come away, at the very least, with enough tchotchkes to make your kids happy and pick up a few bags. And, of course, you can visit Don and the boys at Volex. What booth are you going to be in, Don? Do you know?
No, I don't have the exact number right now. I'm sorry about that, but we were in a good prominent location last year. We had a double booth, a good size. Same will be true for this year. And we will have some nice handouts, including a really beautiful kind of knock your eyes out volatility poster that is fresh off the presses. So
please tell me you're in that poster, Don. I want the Don Schlesinger volatility poster.
No, none of us, but come and stop by. We'd be delighted to talk to you and anybody in our listening area who will be in the Chicago area. Please stop by. As Mark mentioned, the show is terrific. There's an awful lot to see and to do, and we'd love to chat with you.
I somehow envision you in an Uncle Sam top hat pointing at the viewer in the poster and saying, I want you to trade vol contracts. I can just see that done. Perhaps that's an idea for a future poster there.
Okay, that'll be the next one.
And I also want to thank you, of course, the listener, for downloading and streaming and subscribing to this show and making it such a success. And we hope to see you next week at the live show at the FIA Expo there in the Hilton in Chicago. So we'll see you next week.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.